Hi, I'm James Robinson, and this is my stock pick of the week. This is the fifth and final section on the company Westwood Holdings Group. Today we're going to look at the company's wealth creation characteristics. So when I'm looking at wealth creation, what I'm really trying to do is figure out what is it about this company and what is this company's management doing that's enhancing value for the shareholders. And there's any number of things a company can do that will create wealth for the shareholders. They can build up cash, they can pay down debt, they can pay dividends, they can buy back stock, they can increase operations or margins. There's all kinds of things a company can do, which in the aggregate in the long term will show up in the stock price of the company. And so what we try and do is bundle all that into one section, and we call it wealth creation. And so that's what we'll be looking at today for Westwood Holdings Group. Before I go any further, I'd like to suggest that you follow me on Twitter. My handle is @robinsonstocks.com. And the reason to follow me on Twitter is, first and foremost, you'll get real-time information on trades. Oftentimes it takes me a couple of days to put a video together on what's going on or why I'm doing things. Also, sometimes I'm buying companies that I've already done videos on, or I may sell a position that I have, and I won't put that in a video when I do that, but I will always put on Twitter whenever I buy a stock. For example, today I increased my holdings in T. Rowe Price. You'd only know about that if you're following me on Twitter, but if you were, you'd see instantaneously when I did it. You'll also know when I sell something. That helps you to replicate the returns I'm getting, or at least see what I'm doing and maybe follow along. Also, you'll get news and thoughts on the market and stocks in the portfolio. And I also post articles or YouTube videos on there that I think are interesting when I see them. So if you're interested, my handle is @RobinsonStocks. Finally, before we get to the videos I've talked about over time, one of the things that I really get a charge out of for doing these videos is seeing where people from around the world are following me or are subscribing to me or following me on Twitter are. And so this is a map of where my known current subscribers are. I'd love to put your dot on the map wherever you are. Just write down in the comments below, hey James, thanks for the video, and I'm following you from London, England, or I'm following you from Johannesburg, South Africa, wherever you might happen to be from. I'll put a dot on the map, and it's really the only thing I'm getting out of these videos, so if you take the time to do it, I'd really appreciate it. The first thing that I look at, and I don't do these in any particular order, but the first thing that I look at when I'm looking at a company and its ability for wealth creation is what's happening with the shares outstanding. The logic here is that oftentimes companies will buy back shares. It's one of the things that corporations will do to benefit their shareholders because they have the same amount of profits being spread out over a smaller number of shares. That should mean that the profits increase proportionately, and it also should mean the stock price increases proportionately. Additionally, it's a way of returning wealth to the shareholders where there's not a taxable event. If they pay a dividend, if the company pays a dividend, then the shareholder has to pay taxes on that dividend. But if they buy back shares, the shareholder owns a larger percentage of the company and there's no taxable event to them. The other reason that they do it, and in fact the primary reason that corporations do it, is because it makes it easier to reach targets and to show earnings per share growth. If the same amount of earnings are spread over a smaller number of shares, then the earnings per share will increase. That makes management look like they're doing a great job, even if in fact they're not. And so when you add all those reasons together, you see that's one of the reasons why companies buy back shares. And so the first thing I look at in terms of a company's ability to buy back to create wealth outside of dividends is what's happening here with shares outstanding. Now, just getting into this company in specific, you'll see that this company actually has done the opposite of buyback shares. Since 2006, the company has actually sold shares every year. Now, the only reason that they could justify doing that is if they're getting a good return on the money that's being generated from selling back shares. Also, oftentimes what's happening is the company is using shares to reward employees, and that will reduce the cost for employees in some way. But generally speaking, when I see a company that is buying back shares, that is selling shares, not buying back shares, I assume that we're using that money to fund operations, and it's a big turnoff for me. And I had to dig deep into this company to really decide that I would give this company a break. Also, one of the things that's happened, it doesn't show up here, is that this chart only goes to 2019 because that's the last full year we have results for. But in 2020, this company's actually bought back 500,000 shares, just under 500,000 shares. So I think the company recognizes our shares are really, really cheap and we're going to buy back shares. In the next slide, you're going to see why I'm not tremendously upset this company's sold shares, because you're going to see that the shareholders' equity has increased disproportionate to the amount that the shares were bought back, as well as cash. So the company has been doing intelligent things with the money they've been getting from selling back shares. So I give them a little bit of a wash, but it's still not good. And generally speaking, it's not something that excites you about a stock when you see that they're selling shares and the number of shares outstanding is in fact increasing year over year. What's worse, your share of the company's earnings would have gone from about $1,780,000 10 years ago down to about $460,000. Now, there's a couple of things here, a couple of caveats we have to put in. Number one, that's actually not a straight downward trend. It's only been that low for a year or two, and the company has had some rough times, but you actually would have done much better. It would have gone up for many of those years, and you would have had a net significantly more profits over those 10 years than you actually had. But just in the last year, it's gone really bad, and that's why those numbers are so low. And it's not a sign that you would normally like, except that the stock price is now so low that while I wouldn't have liked to have owned it 10 years from now till today, I do really like the idea of owning it today. Again, looked at another way, your earnings would have gone from $2.70 a share 10 years ago to 70 cents a share now. However, you didn't buy it 10 years ago, you're buying it now. You're buying it at 70 cents a share, and I strongly believe those earnings are going to increase dramatically over time. Now, the good news in this chart is what's happened with stockholders' equity. So stockholders' equity is all of the company's assets minus all of the company's debt. It's pretty simple, and it's a good way to figure out what the company's worth. And you can see again in 2009, the company had about $45 million of stockholders' equity. Today, it has about $135 million in stockholders' equity. So it's basically tripled in 10 years. And so to keep that in perspective, the value of the company has tripled in 10 years. Your ownership stake in the company has decreased by 21% as a result. They've sold back shares. So you're still doing fine on that margin. Now, again, you wouldn't want to have owned it 10 years ago because the market has really been hard on this stock in the last couple of years. But we believe it's going to come back. And we believe that when it does come back, you'll have done great. But like generally speaking, in terms of the company was based on stockholders' equity, and we think it should be, and in fact, you could argue that today it is, this company would be performing very, very well because it's tripled in the last 10 years. And in theory, if they just kept doing what they've been doing for the next 10 years, it would triple again. I don't usually do this, but I also included this slide, which is stockholders' equity per share. And I did that because we talked about the fact that the number of shares outstanding has been increasing, which means that shareholders' equity is being spread out over a larger pie. And so I wanted you to have a sense for what's really happening here. Again, in 2009, it was about $7.50 per share in stockholders' equity. Today, it's about, call it $16 or $17 per share in stockholders' equity. So even though the number of shares has increased dramatically, you still had a net doubling in the value of your stockholders' equity per share. And all I'm trying to point out here through a different prism is that this company has managed to increase its shareholders' equity per share, even though they've sold additional shares to the marketplace. And so that's a good sign that those selling of shares to the market was not in any way really diluting the value of the owner's equity in the company. It's just diluting the percentage of the equity in the company. But because they own a slightly smaller percent of the company, but it's worth that much more. It's like owning a small piece of a much bigger pie, if you will. So return on assets, this is a chart that is a little bit misleading at first. So return on assets is something we really like because every company needs money to make money, but the more money they need to make the same amount of money would make a company less and less attractive. And the less money they need to make a significant amount of money is more attractive. So we call that return on assets. How much profits can the company generate for every dollar of cash that they need to run their operations? And so you look at this chart and it looks like it's gone down, and it has gone down dramatically, but it's gone down dramatically from an exceptionally high number to a very good number. If you look at this line, 10% return on assets is a very, very solid company. And this company has been above that number. It's been at 250 times in 2008. And while it's come down, it's still spent much of the time at a 40 or 50% return on equity. So those are fantastic numbers. Again, we know in the last couple of years, this company hasn't done as well. And so this number has dropped down, but it's still in the range of 10%. And so it's still fantastic. It's just not as good as it was. And that's one of the reasons why the stock has been beat up. People were buying this company because it was so exceptional. And now they're saying, well, it's not exceptional. It's just really good. And I should get out of this stock. So look at this stock, look at this number closely, look at the chart in context. And I think you'll see it actually points to the company being in good shape, not in bad shape. Return on shareholders' equity. So one of the problems with return on shareholders' equity is that one of the easy ways to get a really high return on shareholders' equity is to have a little bit of profits and a tremendous amount of debt. Because if you have a tremendous amount of debt, then you don't have any real equity. And if you have no equity, then a little bit of profit generates a gigantic return on equity. This company has no debt, and it has lots and lots of cash and assets. So its returns on equity is going to look a little bit anemic, but they're not, because there's no risk associated with the debt. Now, I would still like to see them, between 10 and 15%, and in the last year they've dropped below that. Again, I think there's unique reasons why that's the case, and I'm not worried about this company coming back. But you can see that for the first time last year, they dropped, the first time since 2001, which was obviously a financial crisis. These guys dropped below the number we're looking for. I don't think that that's the fact that's going to sustain. I think this company in 2021, after the COVID crisis has passed, this company's going to return above this line and really start to generate real profits for us again. But this is the chart, and it is what it is. But I wanted to give you that background for why, when you look at this and you see at the red is the top 10% of all companies, but that also includes all those companies with tremendous amounts of debt, which are then able to get fantastic returns on equity because they just don't have much equity. So retained earnings are monies. When a company makes a profit, there's a number of things they can do with that profit. They can pay it out as dividends. They can pay it to their employees. They can invest it in the business. They can buy back stock. They can reduce debt. One of the things, when they invest the money back in the business, that's retaining those earnings for the business's use. And the problem is that we don't want companies that need to retain a tremendous amount of money to be operating, because that means there's never any money to pay us, the shareholders. We like companies that don't need to retain a lot of money. And you can see that between 2006, for example, and 2013, they retained very little earnings. And as a result, they got these fantastic returns on their operating assets. In 2013, it started to balloon a little bit. It's flattened out since 2015. And the last couple of years, the return on retained earnings, they actually had negative retained earnings, but that's not necessarily a good sign. That's because they were paying more in dividends than they were earning, and so they were retaining zero cash. It's not a healthy situation. It's not one that's sustainable. We talked about that in the dividend section, that the dividends were probably unsustainable for a few years, and they frankly used COVID, in my opinion, as an excuse to wipe the dividend out, get some things sorted out. I suspect the dividend will come back in a year or two. But that's what's happening with retained earnings. The company's retained earnings have basically been flat or zero since 2014, and that's a good thing. They've now been starting to go negative, and I don't think that's a good thing. I'd like this company to sort of stay where they are and kind of flatten out going forward, and we'll see if they're able to do that. One of the things that the tools that I use to look at a company's retained earnings is you say, okay, if a company retains a bunch of earnings, what good is that doing the company? And normally what I do is I say, okay, if we take 10 years of retained earnings, then let's also see what's happened to the profits over those 10 years. If the profits have gone up, for every dollar of retained earnings, they've been able to make the profits go up 10%, then that means they're efficiently using those retained earnings, and I will continue to give them a grace period and allow them to continue to retain earnings. If they're not able to generate a 10% return on those retained earnings, then I start saying, why do you need all this money? Maybe you're just not a very good operation, or maybe you're not a very good investment for me. So I look at on a running 10-year period. It's not scientific, it's not perfect, but it's just a good proxy. It's one of the things that you look at. So you look at this company and you say, okay, basically every year between 2014 and 2018, they were able to meet my goal of they were intelligently using the retained earnings over the last 10 years and generating profits over the next 10. That's fallen apart in 2018 and 2019. So again, if I thought that this trend was going to continue for very long, I would get out of this stock. I think there's reason to believe that it's going to turn around and the company's going to start doing well again. And that's the reason I'm buying the stock. But the return on retained earnings, the earnings they have been retaining was okay, but now maybe not so much. This is one of the great things about this company. In 2006, they started to retain and hoard cash, and the real value of this company today is in that cash that they've been hoarding. They went up to $120 million in cash between 2006 and 2018. So in 12 years, saved about $10 million a year. For a small company, that's an awful lot of money. In 2019, they gave a little bit back. They've given more back in 2020. part of that's because of the COVID, part of that's because their operations were off, and part of that's because they bought back a bunch of shares, which I think they bought back very, very cheaply. So I'm appreciative of that. But generally speaking, one of the things that really interests me about this company is that it has so much cash, especially cash and market value and book value relative to the current market cap of the company. Effectively, we're buying this company at the value of its cash, or pretty close to the value of its cash, and we're getting all the operations for free, which is all along has been my premise for why I like this company. That coupled with the fact that it has no debt, so I think it has a lot of staying power. So this slide right here is the main reason why I liked the company, why I got interested in the company, and why I'm suggesting you should buy the company. It's also one of the real drivers of the wealth that the company has created for the shareholders, is that they have been able to put aside a little bit of cash every year. So we talked at the beginning of this slide, of this presentation, about that this is about wealth creation. And so the way I look at it, there are a number of things the company can do that can increase its wealth for the shareholders. And that if the company does these things that increase wealth, and they do them every year and they do them over time, that it will positively and generally proportionately affect the value of the stock. So if you do smart things that increase the company's value over time, that increase in the company's value will be reflected in the stock price, and the stockholders will be rewarded. So those things are annual changes in debt. The company's never really had any debt, so that hasn't been much of an issue. Dividends, the company has paid dividends. That's wealth to us, the shareholders. We appreciate that. Stock buybacks, net stock buybacks. The company's had negative stock buybacks for a number of years, but then it's come back in the last year, we know they bought back 500,000 shares. An increase in cash. And the increase in cash, of course, has been the big one. But when you add all these up, the categories up each year, you can see that the company has created significant wealth for the shareholders. And you can see the value of the company, the value of the wealth created has gone from about $10 million in 2004 to about $100 million today. And the company's value is about $95 million. So you can see that the company's value of the company has really followed this line of the company's ability to create wealth. Now, we'd like to see that magnify. We'd like to see PE get higher. We'd like to see the profits get higher, and we think we will. But in any case, this sort of proves my treatise that if you chart the total wealth created over time, that will pretty closely mirror the value of the stock over time, and we've seen that happen in this case. So again, that's one of the reasons why I'm really bullish on this company. So in the wealth creation section, independent of the stock that I'm advising, I always talk about my portfolio and how my portfolio is performing. These are the stocks that I currently own, as well as the date that I bought them, how many days I've held them, how much I invested in them, how many shares I own, what price I bought the shares, what the current price of the shares are, what my dividend profits are, and what my total profits are. And you can see that for the shares that we're currently owning, we're doing very, very well. Many of these stocks are up 10, 20, 30, 50, and 100% since I bought them. And I didn't buy them all that long ago. In fact, the oldest stock position I currently have is back from March. However, this is just the stocks that I currently own. And if you look at this, you'll see that I still am about 50% cash and about 50% invested in the marketplace. And I'm up about 0.5% for the year, so not very much. That's because, as we're going to show you in the next slide, like everybody else, we got slaughtered when COVID hit. A bunch of stocks that went up earlier in the year lost all their profits. A bunch of stocks that went down, we sold perhaps below where we bought them. But when you add up all of these gains and all of these losses, as well as all the gains from our current portfolio, we see that we are up about 0.5%. The S&P 500 is up about 1.5 points. So I'm off relative to the S&P by about 1%. I think we're going to catch and pass the S&P 500 this year like we have in previous years. I think we're well positioned to do that. But this is where we are right now. And you're welcome to follow those stocks and check them out. But again, everything that we've got here, every trade that we've made, when we bought it, when we sold it, the price we bought it, the price we sold it, all of that data has been tracked on Twitter in real time, so you can see that none of this is manufactured. It's all legitimately our results. I am very much heavy in cash. I think I'm going to remain heavily in cash until probably around the election. I think October is going to be a bad month for the market. The rest of September and early October, it typically is. And with this being such a weird election year, I just think people are going to get the jitters, and they're going to sell out of a lot of positions, which is going to give us a lot of real buying opportunities. So that's where we are. That's the final part of WHG, which is Westwood Holdings Group. Thank you very much for your time, and happy trading.